Good afternoon, everybody. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services. And it's time for our weekly wrap up. Graham, I understand last week was a tumultuous week in the market. What can you tell us about that?
Well, I think you hit the nail on the head, Stacy. It really was. All indices were down last week. The NASDAQ had its biggest drop, roughly around 13 odd percent, its largest drop since October of 2008. And a lot of the concern was on earnings. We had a really big disappointment with Amazon, one of the FANG stocks, one of the leaders in the market from a cap size. We also had some fears on gross domestic product. Is this really signaling that we are going to go into a recession, or is the Fed going to take the steps from a hawkish standpoint, meaning raising rates to such an altitude that might push us into a recession? Of the markets we saw, from small cap to the S&P to the NASDAQ, all down 3.9% last week, across the board.
Okay, well, what does this mean as far as a recession goes?
Well, I think it's still out there, right? I don't think this says we're going into recession or we're not going into recession. I think it's more of a wait and see game. How aggressive does the Fed have to be? Is the consumer going to react negatively, meaning protract on their demand for goods and services as inflation rises? Right now, we have a strong consumer. We still have strong corporate earnings, even though we are seeing some numbers that are slowing, but it's not to such a magnitude that, at least at this particular point, we think we're looking at a recession. You know what, Stacy? We might just be in a good old-fashioned correction in the market. That's 10%. A bear market is 20%, and that's where we see the small caps and NASDAQ 23+% down, where we see the S&P from its high, the Dow from its high off about 14 to 10%. So as we mentioned to our viewers last year and clients, 2022 is going to be tough. And I think until we get clarification on the pace and the effects of rising interest rates and the consumer in terms of demand, we're just not going to know what this picture looks like quite yet on a recession, or how deep and how long this market might pull back.
Okay, well, do you suggest everybody just sit tight? Or do you think that there's anything that our viewers can do?
Well, I think, as we've mentioned over and over, I feel like a kind of a broken reel, if you might. But yeah, if you got a plan in place, execute your plan. Just because we go through periods of volatility of 10%, 15, 20 odd percent, doesn't mean these markets can't bounce back in the next 4 to 6 months to 9 months. The average recession is only 15 months long. The average correction, peak to trough, meaning 10%, is only 4 to 6 months. Maybe a 20% pullback might be around 9 months in terms of peak to trough. So trying to time the market, it's been a losing bet. So I don't think timing the market makes sense. But I would say this, as we've been saying all along, up the quality in your portfolios, right? If you're reaching for these high growth, cool products, but no real earnings, use the rallies in the markets to pull back on those positions, increase the quality of the portfolio in good, steady Eddie growers, hopefully that do strong buybacks, strong dividends, have a strong moat to barrier of entry around the product, and have a solid product or a service that's been proven in the market. And if you focus on that through a good plan, a good diversified portfolio, you can ride this out. But when you don't, you're apt to be more emotional in making emotional decisions instead of business ones. And I think we know they just don't work out well.
Right. Well, you're always the voice of reason. Thank you for that. Okay, thanks to our viewers. I appreciate you tuning in today for our weekly wrap up, and we will see you next week. Have a great week, everybody.
Take care.